356 to 1. That ratio, that single number. Hold it in your mind for the next 10 minutes, because everything you are about to hear connects back to it. As of today, March 11, 2026, silver is trading at $88.05 per ounce. That is a metal that was sitting at roughly $33 just 1 year ago. Up 165% in 12 months. Up 16.56% in just the past 30 days. And yet, right now, in this exact moment, the paper futures market on the CME is flashing red. The May 2026 silver contract sits at $87.78, down 2.02% on the session. Gold, meanwhile, holds steady at $5,202 per ounce, while the DXY dollar index clings to 98.85, a dollar that has lost over a point from its March 2nd high of 99.68 and cannot find its footing. The dollar is weakening. Gold is near all-time highs. Silver pulled back from 121.67, and the CME just experienced the single most dangerous delivery cycle in its modern history. This is OG John AG, and what I'm about to show you is not theory, not prediction, not hype. These are the mechanics of a market that may be entering a structural breaking point, and most of the people watching silver from the outside have no idea what the number 356 actually means for them. If this is your first time here, this channel exists for one reason: to cut through the noise with data and logic, not emotion and hype. Hit that subscribe button only if you want the kind of information that takes longer to find than most analysts bother to dig for. We're here for the serious conversation. Let's get into it. 8 days remain in the March 2026 COMEX delivery window, and the institutions sitting on massive short positions are watching the clock with a very specific kind of dread. Here is what's already happened, and here is what happens if the math doesn't resolve before that clock hits zero. Let's begin with where silver actually stands right now, as of this morning. 88.05. That's the live spot price, as reported by JM Bullion at 1:48 a.m. Eastern Time on March 11, 2026. Goldbroker shows 88.17. Provident Metals shows 89.18. Yahoo Finance's session data for today shows an open of 87.45, a high of 88.45, a low of 87.13, and a close of 88.12. These numbers are not from a week ago, not from yesterday. This is today's silver market. Now compare that to where silver was exactly 12 months ago, around $33 per ounce. The metal has done something no mainstream financial model predicted. It has more than doubled. Twice over, in 1 year. And the people who dismissed silver as just an industrial commodity are now recalculating their positions in real time. But here is where the story actually starts. Not at 88, but at 121.67. That was silver's all-time nominal high, hit on January 29, 2026, a number that rewrote the history books, surpassing even the legendary Hunt Brothers era peak. In just January alone, silver surged 54%. It kissed 113.25 at one point, consolidated, pushed again toward 121.67, and then, violently, the CME group changed the rules mid-game. Margin requirements were raised from 15% to 18% in mid-February. The leverage unwind that followed was brutal and deliberate. Silver was smashed back toward the 80s. That's where we find it today. And the question every serious investor needs to answer is this: was that margin hike the end of the move, or just the reset before the next leg? Hold that question, because the answer requires understanding something that almost nobody on mainstream financial television has explained properly. The number 356, that is the ratio of paper silver to physical silver at its peak. For every single ounce of real, tangible, deliverable silver that existed in registered COMEX vaults, 356 ounces had been promised on paper contracts. Not 5 to 1, not 10 to 1, 356 to 1. This is not a conspiracy theory. This is simple, verifiable arithmetic derived from open interest data versus registered warehouse stock reports that CME Group itself publishes. The registered silver stocks, those specifically designated and legally available for physical delivery, had fallen to approximately 86.1 million ounces by the end of February. That represents a 31% decline from levels seen just a few months earlier. 31%, gone, in months. And then came first notice day for the March contract. On that single day, delivery notices were issued for 10,526 contracts. Each contract represents 5,000 ounces. Do that math, 52.63 million ounces of silver demanded for physical delivery in a single notification period, against 86.1 million ounces of registered inventory. That is a delivery demand representing more than 60% of every registered ounce sitting in every COMEX-approved vault in the United States, in one cycle. This is the stress test the silver market has been building toward for 3 years, and it's happening right now. Here's what makes this different from every previous silver squeeze. And here's the fact I want you to sit with before we go deeper. The silver borrowing cost, known as the lease rate, has exploded to between 6.3% and 7.3% annualized. In a normal, well-supplied silver market, 1-month lease rates sit at 0.3% to 0.5%. That's the baseline. Right now, those rates have risen 1,460% above normal, not 14%, not 140%, 1,460% above where they should be in a functioning market. That is not a tight market. That is a market screaming for physical metal that does not exist in sufficient quantity to meet the paper claims written against it. And there is one more technical signal that confirms what the lease rates are saying. The futures curve itself has flipped. Starting in late 2025, silver's futures curve inverted. Nearby contracts are now more expensive than deferred ones. This condition is called backwardation. It means the market is screaming, I need metal today, not tomorrow. Backwardation in silver is not normal. It is a structural alarm. In a moment, I'm going to show you a data point that recontextualizes everything I just said about the COMEX. But first, let's put gold and the dollar in frame, because those two variables are telling a story of their own. Gold is at $5,200 per ounce this morning, $5,202 per troy ounce. Gold is up 20% just since the start of 2026. It has risen 78% in the past 12 months. And the gold-to-silver ratio currently sits at approximately 59-1. It currently takes roughly 59 ounces of silver to buy 1 ounce of gold. Historically, this ratio has averaged closer to 47-1. At certain crisis peaks, it compressed to as low as 15-1. At today's gold price, a compression of this ratio from 59.1 to just 47.1, still well above the historical floor, would price silver at approximately $110 per ounce. A compression to 30.1 would put silver at 173. These are not predictions. These are the mechanical implications of a ratio that has historically always reverted. Now look at the dollar, DXY at 98.85 today. It peaked at 99.68 on March 2nd. Then on Friday, March 6th, payroll data came in disappointing. The U.S. added only 130,000 non-farm jobs in February, barely half of what was forecast. And the dollar dropped 0.35% on the session. Markets are now pricing meaningful Federal Reserve rate cuts later this year. The macro backdrop for silver is not just positive. It is arguably the strongest structural setup the metal has ever seen simultaneously operating at multiple levels at once. Now, that data point I promised you, the one that reframes everything. On January 1st, 2026, China imposed formal export licensing controls on refined silver, effective immediately. Of the hundreds of companies involved in silver trading and refining in China, only 44 were granted export licenses. 44. And China does not just produce silver. China controls approximately 70% of the silver that global big tech, artificial intelligence infrastructure, and solar power manufacturing actually need. Beijing has not banned silver exports, but Beijing has decided who gets to export silver, and more importantly, who doesn't. The immediate market effect was a persistent price premium of $8 to $13 per ounce on the Shanghai Gold Exchange versus New York prices. That premium is a geographic demand signal. Physical metal is being priced higher in Asia because it is harder to obtain through official channels. The arbitrage routes that traditionally equalize prices between East and West have been severed, and this is driving a directional flow of existing Western vault silver toward Asian markets, which is precisely why LBMA-eligible silver stocks in London have shrunk to approximately 155 million ounces. Annual global silver demand runs between 900 million and 1.2 billion ounces. London's accessible float is 155 million ounces. That is less than 2 months of global demand, and that number is still falling. The structural deficit underpinning all of this is not a recent phenomenon. It has been building quietly since 2021. Between 2021 and 2025, 5 consecutive years, global silver demand exceeded mine supply every single year. The cumulative shortfall across those 5 years reached approximately 820 million ounces, nearly equivalent to the entire annual output of every silver mine on Earth combined. Now in 2026, that gap is entering its 6th consecutive year. Total global silver supply is forecast to rise only 1.5% to a decade high of 1.05 billion ounces. Mexico leads global production at 6,300 metric tons annually. Peru follows at 3,100 metric tons, holding 140,000 metric tons in reserves, roughly 22% of known global supply. China produces 3,300 metric tons, but its own domestic consumption and export controls mean very little of that flows west. On the demand side, industrial consumption now accounts for more than 50% of total silver demand. Silver is inside the electrical systems of every electric vehicle, inside every solar photovoltaic panel, inside every semiconductor chip, inside the radar and communication systems of defense platforms globally. The Silver Institute forecasts automotive demand for silver growing at a compounded annual rate of 3.4% between 2025 and 2031. AI hyperscale data centers consume silver for conductivity and reliability in quantities not modeled in any pre-2023 demand forecast. The projected shortfall for 2026 alone. Conventional estimates put the deficit at 67 million ounces. J.P. Morgan's physical supply-demand analysis projects the 2026 physical deficit at 245 million ounces. That range, 67 to 245 million ounces short, tells you how contested the methodology is. But even at the most conservative end, 2026 extends the cumulative deficit well past 800 million ounces. Silver ETFs have absorbed 150 million ounces of inflows this year alone. The Sprott Physical Silver Trust has frequently traded at a premium to net asset value. iShares SLV faces renewed questions about its ability to source physical metal during peak demand. That distinction matters. Pull up the CME open interest data right now while this is playing. Look at the registered inventory versus open interest numbers. The COMEX has deployed every tool available: margin hikes, cash settlement incentives, alternative contract structures. The institutions holding net short exposure, HSBC, UBS, Barclays, Citigroup, Bank of America, are sitting on positions that become exponentially more dangerous as registered inventory continues to decline. J.P. Morgan notably pivoted to a net long position in late 2025. They were not the ones left holding the bag when prices moved, and that asymmetry is still unresolved in this March delivery window. Wheaton Precious Metals just locked in a $4.3 billion silver streaming agreement with BHP Group tied to the Antamina mine in Peru. That deal is expected to boost Wheaton's 2026 silver production by 11%. Pan American Silver has provided 2026 production guidance of between 25 and 27 million ounces. These are not companies acting like silver is going back to $20. There is another layer to this market that is almost never discussed. It requires understanding what happens structurally when institutions that are short silver run out of runway. The term cash for delivery, reportedly deployed in the current March 2026 COMEX cycle, refers to the exchange offering cash incentives to traders willing to close their long positions rather than demand actual physical metal. The exchange is paying people not to ask for what the contracts legally entitle them to. A futures contract is a legally binding promise of physical delivery. If the exchange is compensating participants to waive that delivery right, it is implicitly acknowledging that fulfilling the delivery obligation creates systemic risk. The CME Group does not offer cash bonuses lightly. When they do, it means the alternative is worse. 150 million ounces of silver have flowed into ETFs in 2026 alone. Mexico, the world's largest silver-producing nation, mines approximately 6,300 metric tons per year, which is roughly 202 million ounces. The ETF inflows this year alone represent approximately 74% of Mexico's entire annual mine output absorbed into financial vehicles, unprecedented demand from the investment side, running simultaneously with record industrial consumption. And here is one final mechanical point. Most silver, roughly 70% of total mine production, does not come from primary silver mines. It is produced as a byproduct of zinc, lead, and copper mining. When silver prices rise, miners cannot simply pivot and produce more silver. They have to mine more base metals to get more silver. Base metal production decisions are driven by base metal economics, not silver prices. The supply response is fundamentally constrained. You cannot build a silver mine in response to a silver price spike in time to matter for the 2026 delivery cycle. That constraint is structural, permanent, and almost never explained. Now let's have the honest conversation, because intellectual honesty is what separates analysis from cheerleading. The bearish case for silver is real, and it deserves to be taken seriously. Marko Kolanovic, former chief market strategist at J.P. Morgan, has issued a blunt warning. With silver having surged past $100 per ounce at its peak, Kolanovic sees meme traders attempting to take over the market, and a speculative mania that typically ends with violent mean reversion. His call: silver crashes back toward $50 before year-end. That would represent a move of approximately 43% below current prices. That kind of correction is not impossible. Silver has done it before. MKS PAMP analyst Nikki Shields described current price action as exhibiting unheard-of volatility, driven not by physical supply and demand fundamentals, but by wild liquidity flows. Galena Asset Management's Maximilian Tomey stated that fundamentals alone cannot explain a commodity rallying over 200% in this time frame. When two separate analysts use the word broken to describe a market's behavior, that is a professional acknowledgement that something in the pricing mechanism is disconnected from observable reality. Add to this the solar sector dynamic. With silver fetching $2.5 million per metric ton, solar manufacturers are accelerating the transition to copper-based alternatives. Silver demand from photovoltaic installations is projected to fall to approximately 194 million ounces in 2026, down 7% from the prior year. High prices incentivize substitution. Substitution reduces demand. Reduced demand suppresses price. That cycle is real and already beginning. The CME's own margin increases, and from 15% to 18% in February, demonstrate that the exchange views the current leverage levels as dangerous. If they raise margins again, another wave of forced liquidations could compress prices further toward the $70 range. The bearish case is not that silver is worthless. It is that the speculative component of the move has already priced in the physical scarcity story. Both realities are in this market simultaneously. Paper says caution. Physical says something else entirely. And they cannot both be right at the same time. In the 1970s, gold surged from $40 to $200 per ounce. Investors who bought near the early peak watched prices cut in half. They capitulated, and then gold ran to $800. The mean reversion that shook out weak hands was not the end of the secular trend. It was the reset that made the final leg possible. What differentiates 2026 from every previous silver cycle is the strategic reclassification of the metal. Silver was added to the U.S. critical minerals list in late 2025. When a commodity becomes a critical mineral, the industrial users who depend on it are no longer purely price sensitive. They become supply security driven. They stockpile. They sign long-term offtake agreements directly with miners. They bypass the COMEX and the LBMA entirely. And when large industrial users bypass futures exchanges for their physical supply, the pool of metal available for financial settlement shrinks further. The era of just-in-time silver delivery from exchange warehouses may be ending, not dramatically, not overnight, but structurally, methodically, one offtake agreement at a time. J.P. Morgan's official 2026 average silver price forecast is $81 per ounce, more than double its 2025 average, but substantially below where silver trades today. J.P. Morgan's own physical analysis projects a 245 million ounce deficit. Their paper price forecast and physical deficit estimate exist in uncomfortable tension. An $81 average implies the price we see right now, $88. Will spend significant time lower this year to pull that average back down. That is near-term price risk that deserves respect. Trading Economics pegs end-of-quarter silver at $79.76 with a 12-month projection of $91.05. Bullion by Post data shows silver's 3-month high was $122.88. The current $88 represents a drawdown of approximately 28% from that high. Analysts at Trading Keys see a 2026 consensus range of $55 to $70 in a normalization scenario, with a bullish spike potential toward $150 if the paper market dislocation intensifies. That spread, $55 to $150, is not analytical failure. It is an honest representation of a bifurcated market with two completely different potential futures operating simultaneously. The physical market and the paper market are not telling the same story, and until one of them concedes to the other, the volatility will be extreme. What you now know, and what most people watching this market still don't, is the anatomy of a potential restructuring of how silver's price is actually discovered. The COMEX registered inventory at 86.1 million ounces. Delivery demand of 52.63 million ounces, representing over 60% of that inventory in a single cycle. Lease rates at 6.3% to 7.3% versus a normal floor of 0.3% to 0.5%. Backwardation in the futures curve. China export controls effective January variant, limiting silver flow through 44 companies. The $8 to $13 Shanghai premium. LBMA eligible float shrinking to 155 million ounces. The 820 million ounce cumulative deficit since 2021. The 2026 deficit projected at between 67 and 245 million ounces. DXY at 98.85 and falling. Gold at 5,202. Gold to silver ratio at approximately 59.1, historically elevated. This is the picture. It is not clean. It is not simple. It has genuine danger on both sides. What it is not is ignorable. You are part of a very small group of people who watched this entire video instead of clicking away when the first number got complicated. That distinction matters. The majority of retail participants in this market are operating on 30-second social media takes and price targets without context. You now have the architecture, the registered inventory numbers, the lease rate explosion, the delivery cycle stress, the China export controls, the cumulative deficit, the institutional positioning asymmetry, the bearish case with real names attached to it. This is what separates investors who make decisions from investors who react to decisions others made. If this analysis gave you something to work with, something you didn't have when you started watching, share it with someone who is trying to make sense of what silver is doing and why. Drop a like. And if you want this level of depth on every major move in precious metals, commodities, and macro, join this channel. Not because I asked, because the data is going to keep moving, and you're going to want to be here when it does. Drop OG John AG 2.0 in the comments right now, not as a bot command, but as proof to yourself and to this community that you stayed through the whole thing, absorbed the whole picture, and are not operating on a headline. The people who drop that comment are the people building real financial literacy, not just collecting opinions. The paper market says 356 ounces for every one that exists. The physical market is demanding delivery. Only one of them can be right. And right now, we are watching in real time which one blinks first. Invest with logic, never with noise. This is OG John AG. The math does not lie.